What's up, traders and investors? Todd here, New Age Wealth Advisors. Happy way too late here. Almost it's 12:30 here on Monday night. I better get to bed. CNBC tomorrow at about 3 p.m. I'm going to bring you the most important data that, from my point of view, from a fundamental technical point of view, show you the adjustments we just made to our portfolio, show you the sector allocations, show you some hedges that we put on, and show you some moves, get into some technicals, have a whole bunch of fun. So let's go. Before we jump in, as I mentioned, CNBC tomorrow and also this week marks the 1-year anniversary since I launched the RIA, the Registered Investment Advisor, which is my wealth management business. Pretty cool. Okay, that being said, I've been quiet here with the communication, and I just want to talk about this market real quickly. This is the kind of market that requires more listening than talking. For someone who's running money, and I'm keeping an eye on my other business, the research business, tradinganalysis.com, which a lot of you know me from. And what I've done is, while I've been quiet here on the communications in terms of the wealth management, I've been spending time sort of getting back in the trenches that I've come up with as a trader, where I develop my skills, getting inside the shorter time frames, really watching the market. And just seeing what's kind of under the hood. That helps me make portfolio decisions at the larger level, which led up to this adjustment and rebalance that I did to the wealth management portfolios just on Friday here. So it's been good. This is definitely the kind of market, as I said, some people get real loud and have a whole bunch to say when, again, I think it's time, if you're being a prudent investor and an analyst and a money manager, it's time to listen. So that's what I've been doing. I've been, kicking a lot of stones over, communicating with some people on social and the team at Trading Analysis, and really getting a gauge for what's happening in the markets, what people are saying, what people are expecting to happen, and all that. So all that being said, let's kind of go down the path here, take a look at data. We've had some housing data, which is interesting. We'll talk about that in just a sec. A lot of Fed speak here. The big one this week are going to be the ISM, the Institute of Supply Management, the manufacturing, non-manufacturing, and then we do have non-farm payroll coming up Friday. Okay, right there. That's going to be interesting because all of a sudden the Fed is talking about the overheated labor market and how too many people are employed, and it'd be better if more people are fired to alleviate demand, which is causing more inflation. I don't know. To me, might make more sense to work on the supply side to the best of their ability, rather than increasing supply, rather than squashing demand by asking companies to lay off people. It's not that simple, but in some manners it is. But so we'll keep an eye on that. Housing has been interesting. We just saw the largest decline. I have to go back. I don't have easy access to get this, but I can do it. The largest housing percent drop year over year, going back a long time. This is the Case-Shiller Home Price Index Composite. It looks at 20 metropolitan areas, and here's a bar chart. You can see that we were at 18.6, or is revised 18.7, dropped to 16.1, so a 2.6% drop. Pretty significant, okay? And if you look at the data here, you can see housing prices have dropped quite a bit. And obviously that has a lot to do with interest rates. The cost to borrow goes up, housing prices go down. You can see it's usually a pretty smooth kind of histogram here, but there's been a very sharp drop in housing. However, which is interesting, if you look at the month over month new home sales, a very sharp increase. So housing sales are going up, and you can't help but wonder, are those cash buyers who aren't as impacted as increased from increased borrowing costs. So kind of watch that. A few pieces of data unpacked there in housing. We'll talk about the macro markets as well, interest rates and the dollar, which are very much driving things here. But before we do, let's take a look at the technicals and technicals are nothing more. Speaking to some of my clients who don't know that, I spend a lot of time getting inside of his, under the hood of the markets, and that includes looking at the data, but also the price patterns on the charts. Really gives you a lot of information about what data is being reported on the TV and in the newspapers and on the website, and what's actually happening, what they call the hard right edge of the chart. What's happening in price? Sometimes what investors and commentators and talking heads, myself included, say should be happening or might be happening in the market is not actually unfolding in the actual market. And there's a lot of times there's a disconnect between what people think should be happening, what is actually happening, and it's kind of our job to uncover that. So looking at the price patterns of the different markets and stocks we follow is very, very important. So a few key technical points. This is the NASDAQ 100. So largest 100 stock in the NASDAQ. It's like 58% technology. It's not all technology, believe it or not. It used to be more so tech, but it's a little bit more of a diversified index. And when I get inside of the portfolio, specifically our growth portfolio in the RAA, I benchmark it to the NASDAQ, and I'll show you the sectors that comprise the NASDAQ. A couple things that I see here. Number one, this green squiggly line, 200 period moving average. You take the closing price of every one of these white bars, and the little tick on the right side of the bar is the close. So this happens to be the close for September of 21, that guy right there. You average out the last 200 closes. Okay, so last 200 weeks. This is a weekly chart. And this moving average tends to be pretty good support. That comes in right just below the June lows, which right around here we allocated more money to the portfolio. We're looking pretty good here. We had about 20% cash. We had an inverse ETF at work here. We took it off, wrote it up, and here we are back down retesting these lows. Okay, so that's the 200 period. Then if you want to get a little fancy, here's a technical trick. Instead of 200, you could do the 192, which is nothing more than there's about 48 business weeks per year times 4. It's 192. That's basically your presidential cycle moving average. Same thing. But you can see that's clearly been support since the 2008 low on several occasions. And we're testing it again. Okay, so not only do we have the June low, but we have the moving average on the week as well. Another source of support is if you were just to draw a simple trend line below the most prominent lows, which credit crisis lows there to COVID lows. You extend that line straight up, and it comes in right there. So, we definitely have some support here. Now, the question is, do we hold? Do we get down here to 10.5 in the NASDAQ, or do we punch lower? I'm going to have a supplementary video for members, for clients of the wealth management business, those who would like to engage in an option hedge to protect against a significant downside waterfall. Watch your email. If you're a client of New Age, you will have access to that video, and I'll explain what that means. Okay, so the big question is, do we hold the support area and move higher, or are we going to break the 200-week or presidential cycle moving average and break down into some deeper support levels? And frankly, it's too early to tell. I don't know. I don't think you can know. I don't think the future's written here. We need to be prepared in either situation. Illiquidity is an issue here. Volumes are getting light. So the situation is very fluid in an illiquid market. Okay. So I've told you, I really have to lift up the hood and get inside of this market. I know a lot of clients on the wealth management side don't want to get inside of the gory details, but look, if you want me to try to steer your car or fix your car, man, we got to get inside of the electronics and really get inside of the guts of this thing. So we're just going to bring it all to the surface, and if it's not applicable to you, that's fine. So this is a study that, this is something called the internals of the market. So it's watching how shares swap back and forth in terms of volume. Watch how they tick up and down. And specifically what we're looking at here is the New York Stock Exchange ticks. This just simply measures on pretty much a second-by-second basis how many stocks on the New York Stock Exchange are ticking up versus ticking down. And when you get a reading that's anywhere from 6, 7, 800, plus 6 to plus 8, even to plus 1,000 or plus 1,500, that means at that time there's 1,500 more up-ticking stocks than down-ticking stocks on the New York Stock Exchange. That indicates one thing: institutional buy-sell pressure. Institutions come in, they don't buy individual stocks. They do sometimes, but for the most part, they hit a button and boom, they go out and buy all 500 stocks in the S&P 500 for size, pushing that tick reading up. So you can see this thing goes back and forth like a crazy EKG all day long. But what I do is throw a moving average on there to smooth it out. And what happens is when the institutional sell programs dry up, you start to see the moving average push higher. What's interesting here is the S&P 500 in purple has been pushing lower over the last week in this very choppy range. So that's called an internal divergence. So there is lessening institutional sell program interest. According to the NYSE tick, it's creating a higher low where the S&P has made a lower low. So it's the institutional sell pressure is starting to alleviate. To get technical here, you could also see that the moving average here has not broken above this level, and it's 285. And this goes back to August, what is that date? August 15th. So you can see we're almost, we're a month and a half of not breaking above 285. So if you get a push above here, that's going to indicate more institutional buy programs are coming in, that's the real volume that pushes the market. That could result in a pretty good short squeeze, which means people who are short have to buy, which would increase price, and then all of a sudden you get some momentum people and people who are waiting with cash in the silence and say, okay, it might be a good time to buy, and then it could kind of feed on itself. Let's hit a little seasonality here. So if you take a look at the S&P 500, what has the S&P done over the last 72 years and in the next few months? So down here is the seasonality. You can see September, horrible, the worst month of the year. Well, it's kind of what we saw. It was a really, really bad month. Seasonally, August is usually pretty flat. July is strong. And if you kind of match it up, look, actually, and I can't really put these right on top of each other, so I'm going to have to kind of walk you through it here. So July was an up month in the actual price up here. Seasonally, it's strong. June is flat. June was down. May was a doji, which is opening, closing at the same price. May's usually flat. But here's the key. October strong, November strong, December strong. We're coming into a seasonally very strong period here. And we're already starting October pretty well. And if you think about what I mentioned there with the NASDAQ weekly moving average and the trend line, and you look at sort of the internals with the NYSE tick divergence, could get something started here. I'm not trying to rah-rah on the bull side, just being objective. This is not a forecast or projection at all. The same thing with Apple, and I thought this was interesting here. So June is one of the worst months for Apple, and this is June. July was good. July is typically good. Here's where we were diverged a little bit. August was kind of a flat month. We opened up here, but then closed down there. August is actually the best month usually for Apple, and then September is followed by the worst. Well, that certainly kind of came true there. September was lousy for Apple. And then October is one of the, I would say, the second or third best months behind August and January for Apple. So we'll certainly watch what happens there. Flipping over to RRGs, relative rotation, what we're doing is watching how the sectors rotate around the intersection here of the XY axis, and that is the S&P 500. A couple notables, we'll get into it when we talk about the portfolio, but energy it's interesting. It hasn't gained any relative strength, which is by moving right on the chart, but it's gained a lot of momentum. Okay, and it's kind of it's tough to distinguish between the two, but it's performing well, and we've been overweight energy since we launched a year ago. I decreased the amount that we were overweight back in July, and actually just re-increased our overweight. Actually put more energy back on. It's acting very, very well. Today I had a really strong day. So energy is starting to actually gain a little easterly direction, which is good. And down here is going to be really your relative strength compared to your benchmark S&P, which is right here at the center. And the vertical axis is your momentum. One that I'm watching here is this consumer discretionary. It had a very good heading moving from the improving into the leading quadrant. Again, relative to the benchmark, we're starting to roll over here, but I don't want to give up on it yet. If you look over here at a more simple chart of XLY, you can see the XLY chart. Remember how the NASDAQ was retesting those June lows, as I mentioned? Consumer discretionary is nowhere near it. And if you take consumer discretionary and just simply divide it into the S&P, if this chart is moving up, that means XLY, which is your consumer discretionary ETF, is outperforming the S&P benchmark, which I find to be very, very interesting in a time where we're so focused on the consumer being squeezed by inflation, yet consumer discretionary continues to act so well ever since, what is this? Since May, so we're talking 5 months of outperformance in XLY to the S&P. Pretty interesting here. And if you get inside of some of the industries within consumer discretionary, it's very much consumer shopping, consumers going out, buying stuff, doing stuff. There's a lot of debate perhaps that people are spending too much on credit cards and the consumer is leveraged. We'll have to see how that shapes up, but usually it indicate and see the financials come under pressure in that kind of situation for telling, credit card delinquencies and stuff like that. But if you look at XLF, gaining some pretty good strength here, going from improving into the leading quadrant. And you can see on the chart, same thing, XLF into the S&P 500 right here. Financials gaining strength on the S&P, but not above those June lows like consumer discretionary was, kind of holding those June lows, similar to what the S&P is doing. A few more ratio charts here. So this is going to be value to growth. So your iShares big value ETF divided into the growth ratio. Value has been underperforming growth, as evidenced by this falling line for a long time back here. Even before 2017, you could go back here even in the 2000. We have a minor trend line break here. We're coming back and testing what was resistance. It should have been now offering support. If we're truly going to see value outperform growth on a sustained basis, you need to see this guy really start to move higher. Okay, we are in a position that it certainly could do so. But I could just as easily kind of see this failing and falling back below. I'm not giving up on the growth trade yet. Same story here with consumer discretionary divided into consumer staples. Okay, this chart, if the consumer is strong and going to go out and make purchases that are not everyday requirements like laundry detergent and bananas and food and whatever. If the consumer's still healthy and going to go out and spend on luxury items or things like that, especially going into the holiday season, we would expect to see this consumer discretionary, consumer staples ratio move higher like it has been for the last decade or so. We did come into this pretty strong. It was a sharp decline. We're starting to roll back over. So we'll see if it finds some support around the 2 level. But if you were to break below 193, you would say the consumers and markets are betting on staples rather than the luxury goods like consumer discretionary, electronics, and stuff like that. So we got to watch that. Support's still intact, though. It's being attacked. Technology into consumer staples, same thing. Tech, consumer discretionary, similar, kind of markets, cyclical sectors. If you were to break below this 177, tech is losing ground to consumer staples. That would indicate that the market is going into defense mode. There's going to be a CPI report next week, and so much debate, so much evidence out there that CPI inputs into the consumer price index are dropping. Yes, we just haven't seen it yet on the various data reports. CPI, we just saw some GDP pricing data, some PCE, personal consumption expenditure, which was not great data either. And just we're waiting to see downticks and just haven't seen it yet in the data. But it's going to take time to come through. It will happen. And if you look at the TIPS data, so these are securities that are basically factor in what the expected inflation rate will be at various times in the future. So you take the current yield, the nominal yield on treasuries, and then you compare that to where the expected yield are trading on these treasury inflation protected securities, and that gives you an idea where the break-even levels are. But you can see that inflation expectations rallied sharply. So orange is the 0 to 5 year TIPS bond ETF, and then the other are 5 and 10 year. Blue is 5, purple is 10. You can see that the inflation expectations have dropped sharply. So going to a 5-year chart, they're up around 3, 3.5, 3, and then we've dropped sharply here. So you look at the 10 and the 5, we're settling down to 2.15, 2.14, which that's the Fed's target rate. So inflation is certainly looked to want to come off. Another sort of product that a lot of people look at is the yield spread. So where's the Fed going to move rates in the short term? And that's going to be most reflected by the Treasury yield on the 3-month Treasury here in purple. Compare that in orange to the longer dated duration, the longer duration yield, the 10-year, which has more to do with where interest rates are set in the economy, like credit cards and mortgage loans and car loans. The spread between those two, if they get too tight, and actually, let's say the shorter term 3-month goes above the 10-year, that's what you'd call yield curve inversion. And that's generally a signal that recession is coming. Well, we never got it. We never really got inversion getting below the 0 line here on this one. And we're actually starting to move higher. So the yield curve is actually starting to invert. And if you go back to more history, 5 years, 10 years, and all those gray areas shaded are recession, you can see that the yield curve here on the 10-year 3-month got inverted, significantly inverted, which is below the 0 line, this gray line that I'm highlighting on my cursor here. So we got inversion there, recession, inversion, recession, inversion, recession. Well, we did have inversion, and then we went into the very short recession, which is 2020. We came back in a retesting inversion, but we didn't get it. And we're starting to move higher here. We're all of a sudden having 50 basis points difference between that 10-year Treasury and the 3-month. So that's something that we really want to watch closely. We don't have another FOMC meeting until November, so we got to get through the next month, which, as you know, October is a big month, and October 19th, I believe, will be the 35th year since the 87 crash. So everyone's always a little nervous around October anyways, and then you throw what's going on here in the mix, and certainly be interesting. So no Fed meeting, scheduled meeting in October. Not much has happened with the November meeting. We were around 37% chance of going 50 basis points. We went up to 43. Now we're at 46. We were at 62% chance of going 0.75%. Now we're down to 53. So nothing too significant there. And then if you get out here, December, not too much change there to speak about. What I find is interesting is you got to go all the way out to March of 23. You actually see some pretty good movement here. Basically what happened is what we're trying to do is we're trying to figure out what the terminal federal funds rate is. Where is the Fed going to stop raising rates? And it's been flipping around here quite a bit from 4.75 at the lower bound to 4.5 to 4.25. And you can see that, a week ago, they were looking at the terminal Fed funds rate to be 4.75. There's a 16% chance of that. Now there's only 2%. We were a 50% chance a week ago of being 4.5 at the lower bound, went to 45. Now we're at 35. What's happened here is all of a sudden, I think you could take probably the call it the 13 or 14% that's missing here, and basically I think it's been flipped down to the lower level. So you took about 15% chance here, then 50 minus 35, 15 here, basically leapfrog the 4.25 to 4.5 and put it down here. Okay, so we're at a 3% chance a week ago of 4 to 4.25. Now we're at a 15% chance, right? So we picked up, 4.25 picked up the, let's call it the 30% chance of 4.5 or higher as a terminal Fed funds rate and flipped it down here. So what does all that mean? From this point of view, right now, it looks like the terminal Fed funds rate is going to be 4.25, 4.5, or that might mean we might get up to 4.5, 4.75, but the markets are looking for a cut back down to 4.25. But, it kind of seems like, for me, the longer term implication is that we're going to stop at 4.25, and the Fed isn't going to get too crazy cranking up interest rates only to cut them later. Okay, related to interest rates is the dollar. Dollar's been very strong, and this is a chart of the U.S. dollar relative to 6 currencies around the world. It's the euro, it's the yen, it's the Swiss. I think it's Australia, New Zealand. I forgot. It's been a while. But 6 of the major currencies relative to the dollar. And basically what happened is we've gone parabolic. Strong dollar back in 2008 and 9 was not good for the stock market and the credit crisis because the whole world was rushing into dollars for safety, for guaranteed a return of principal. We have a little bit of that right now, but I don't think it's that. I think it's more our interest rates, our yields are higher relative to the rest of the world. So that encourages something called the carry trade, which is borrowing money overseas, buying US dollars to buy higher yielding US investments, including our fixed income, including our real estate markets, and including our stock markets. I don't think this is the same strong dollar market that we saw back in the housing crisis. I think there's something else happening here. All that being said, we just using the kind of the crazy quant analysis technicals that we look at, we did identify some resistance here in the dollar, which is good because generally a stronger dollar is not good for global equities. Various reasons. Emerging markets have a lot of debt priced in US dollars, and it does hurt our multinationals' ability to earn overseas, repatriate that money back home, change in US dollars because you're bringing home less money for their bottom line. So stronger dollar is not generally a good thing for global stock markets. Good news is we did just find resistance in the dollar. Let's look at a macro overlay here. Now, what I've done here is I've taken 2-year treasuries, the US dollar. Sorry, that's the 30. Orange is the 30-year. That's the US dollar. This is the 2-year and the S&P. I basically flipped them all on their head. So I put them all in the same order. So the 2-year treasury, 30-year in yellow is good. The dollar is upside down. It's basically trading like the euro dollar. Okay, so let's call it dollar yen. Okay, or let me say this properly. The dollar is upside down. Okay, so it's like the euro dollar or sterling dollar, or we could say this is like, maybe this is the right way of looking at dollar against the yen for those of you who follow. But this is basically an upside down dollar. Remember, a stronger dollar hurts the stock market. So I want to flip it upside down so we could compare it the same direction as the S&P here in purple. And then here's the 2-year treasury as well. So we have 30s, dollar, 2-year, S&P, but the dollar is upside down. Up here is the yield on the 30-year, which is correctly positioned. What you're seeing here is treasuries pushing lower. 30s, 2s pushing lower, are pushing their interest rates higher. their corresponding yield higher, that creates, again, the incentive for overseas investors to sell their local currency to buy dollar, to buy our higher yielding treasury. So it's going to push the price, right? It's going to push the price down, yields go up. We shall see, but generally it's going to have a negative impact on the stock market, right? So what happened here is the S&P has made new lows in the last week to week and a half, but the bond market, the 2s and the 30s, have come off the lows as interest rates have pushed lower. So generally what you're saying is, as interest rates are going higher, and I'll eliminate everything and show you a very simple chart relationship of bond yields, which is interest rates, and the stock market. Okay, so let me just do that now. So let me get rid of 2s and 30s. Okay, so let's just look at yields, the dollar, and I'll flip it on the right side up, and the stock market, which is the right way up as well. The higher our yields go, the higher the US dollar is going to go. That's by way of the foreign exchange markets. That's pressuring the stock market lower, right? Higher dollar is bad for US markets and global markets, right? And it's bad for our multinationals. So if I give this guy a little bit of scale, as the dollar's going up, the stock market's moving down. What you'll notice, again, is the stock market has made new lows right here, but the dollar and 30-year yields are off the high. So we're losing the macro influence of yields and the stronger dollar on the stock market. That's another bullish sign. Okay, flipping to portfolio adjustments that we've made. So we run two main portfolios, two main equity portfolios, the dividend, the tactical dividend, and the growth portfolio. We've made adjustments to both. We also run a hedged equity, which utilizes option structures to sort of offer like a guardrail strategy that takes the place of fixed income in a way to reduce volatility, get more equity exposure, because fixed income for now is sort of a treacherous game. But we did actually add some fixed income exposure. So let's talk about tactical dividend first. And again, clients will get the full portfolio breakdown, okay, of exactly what we are holding. Okay. Basically what we did in the dividend portfolio is we did reduce exposure in 1, 2, 3, 4, 5, 6 different sectors. Technology was the big one by 4, then communications, financials, industrials, utilities, and real estate. What did we do with that? Well, we increased our exposure in cash and specifically some hedges. We did put the inverse NASDAQ ETF back to work at a 5% allocation. We also put 1 to 3 month U.S. Treasury bill to work at a 6% allocation. I do think, based on everything that I said before, with the dollar at resistance, I think yields on these treasuries are starting to diverge off the highs as the treasury prices are starting to find a low. I do think there's going to be a snapback in those, whether the stock market continues higher or lower. Okay, I think we're starting to lose the macro forces for lower stock markets from FX, which is a stronger dollar, and fixed income. And we know commodities have pulled off sharply and are starting to rally again, because we did actually increase energy exposure over in the growth portfolio, which I'll show you in a second here. And actually we did increase there just a little bit, 1% adjustment there to energy. So we did so as well in the tactical dividend. I should add that as increased as well. So stronger commodity markets is generally going to show an inverse relationship to the US dollar, which would be a weaker dollar. Okay, so that would be good for these markets. Stock adjustments that we made. These are the stocks that we cut. We had the communications, XLC, Spider. Advanced Auto Parts is a stock in a sector in an industry that I like, consumer discretionary and auto parts. Stock's not doing well. There's some problems in the fundamentals. JP is a financial that's been lagging quite significantly I like Morgan Stanley. We hold that. Honeywell, not doing well. There's better defense names to hold. National Grid's a utility that was just doing terrible. Plus, I think I lost power about 3 times trying to do a video like this. I have National Grid, so sell it. No, kidding. The stock was not performing. Stocks that are added, again, a consumer discretionary name, Vail Mountain, which I think their Epic Pass program is going to be another absolute home run this year, and I think people are ready to go out and hit the slopes again. ConocoPhillips increased energy exposure. We did put the Nasdaq Inverse ETF as well as the 3-month Treasury. Let's flip over to the growth portfolio. Same thing. So we reduced technology by 5%, communications by 4%, and consumer discretionary, and gave us a modest increase in energy there at 1%. As well as energy, we did increase cash, put the inverse NASDAQ ETF on, put the ETF, the BIL, which is the 1 and 3 month US Treasury, as well as the 1 and 3 year Treasury bond, SHY. Okay, put that to work. Stocks that we cut at this time was Meta. I finally gave up on it. The stock's gone from over $1 trillion valuation in 2020 down to 350 billion. Just stocks got absolutely destroyed. I am bullish on them longer term, but need to move aside in that stock and let them figure out where they're going in the metaverse. Suncor Energy is a rare weak spot in an otherwise very strong industry, so I cut that one. Added some names that I've been looking to add for a while. T-Mobile, love what they're doing. The deal with Starlink. I think they're really trying to take on Verizon and AT&T or AT&T. Cheniere, really strong energy name. Occidental Petroleum, Buffett increased his allocation again. Put the inverse ETF on as well. As I mentioned, the 1 and 3 month Treasury bill as well as the 1 and 3 year. This is just a short-term play. So as I mentioned, I am going to send out an option hedge for clients attached to this email. I can't do it publicly because I can't really offer an option product unless you're a qualified client. So all that being said, yes, we did put a percent of our cash in treasuries as well as an inverse ETF, which is going to go up as the market goes down. Basically, the reason I did it is I think there's asymmetric risk reward. What that means is if we do get an air pocket and the bullish reasons that I put in front of you don't come out, don't play out, which is very possible, I think the downside is larger than what we'll stand to give up if we do move higher. For instance, I think the potential downside if we don't hold those June lows could be 2 and 3x the amount that we'll miss out on that 20% allocation in our portfolio that are in treasuries and in the inverse ETF by the time we unwind that position and right the ship, so to speak. I think we risk more staying long on the downside than what we'd risk by righting the ship and realizing, okay, the lows are going to hold, time to put some more money to work and unwind the treasury positions and take off the short ETF. And plus, I think even if the stock market does recover, I do think interest rates are going to come off a little bit and those treasuries will move up. So there's not an inverse relationship between stocks and bonds right now. I think they're actually going to fall into a direct correlation. So the NASDAQ inverse ETF is the one that we'll work on. If we feel we're wrong, and I hope we're wrong, to be honest with you. But again, I feel like we're risking more by not protecting, because if we do get it down, a pretty good downwind, pretty good flush lower, it could be larger than what we face on the upside, again, in the time that it would take to unwind that position. Okay, guys, huge long video. Hopefully that helps. Best of luck. I'll be sure to be doing more of these. Again, I've been doing a lot more listening than talking, and maybe I need to do more talking and communicate with you guys, but really trying to get under the hood of this market. So good luck. Hope it helps. Talk to you guys really soon.